I want you to look at the chart on your screen right now. Do not look at the price. Look at the line. That vertical spike shooting out of the candle is not decoration. It's evidence, a flash of violence in the market that tells a much deeper story than the number beside it. Silver didn't climb to $83. It teleported there. One moment it was trading calmly in the high 70s. The next, it was screaming through 80 like gravity had been switched off. And then, just as fast, it fell. From the high to the low, almost $9 vanished in a single session. If you're new to this market, your first instinct is fear. You see that drop, and your brain fills in the conclusion for you. The rally is over. The bubble popped. Everyone else knew something you didn't. But that reaction is exactly why this move happened. Because markets don't punish ignorance. They punish positioning. And what you just watched was not a collapse. It was a trap snapping shut. In a moment, I'll show you the exact level that exposes who was hunted here and who walked away untouched. That detail matters more than the headline number. Let's slow this down. Who was actually buying silver at $83? Not the people who built positions months ago. Not the capital that accumulated quietly in the 30s, the 40s, the 50s. The buyers chasing that Sunday night gap were late, emotional, leveraged. They weren't buying silver, they were buying speed. And the market knows where those traders hide their fear. Most of them used leverage, 5 times, 10 times, some more. And leverage demands protection. That protection is a stop loss, an automatic sell order placed just far enough away to feel safe. For most of the traders who chased the breakout, that line sat right below $75. That's not a guess. That's a data point. When liquidity thins out, when the order book goes hollow, price doesn't need a reason to move. It just needs a push. So the push came at the worst possible time. During a low-volume holiday window when buyers were scarce, a large block of futures hit the market near the highs. Price rolled over, 79, 78. Then it slid into the danger zone. And that's when it happened. Stops fired, thousands of them, all at once. Forced selling doesn't ask questions. It doesn't care about value or trend or conviction. It just sells. That cascade is what took silver from the low 80s to the mid 70s in minutes. Not panic, not fundamentals, math. This is what professionals call rinsing the leverage. It's brutal, it feels unfair, and it's designed to remove the weakest hands before the market moves on. Now look back at that candle. Small body, massive upper wick. Technically, this formation has a name. It's called a shooting star. The wick tells you price tried to stay high and was rejected. To most people, that looks bearish, exhaustion, failure. But context is everything. Before you decide this was the end of something, you need to understand what didn't happen today, because that absence is louder than the crash itself. In the next section, we're going to test this move against reality. Not charts, not screens, reality. We are going to look at what happened when the paper price collapsed and ask a simple question that flips the entire narrative. Did the physical market follow it down? Now let's separate the screen from the street. While that chart was whipping around like it had lost control, something very different was happening off camera. Because when the paper price dropped $9, the physical market was supposed to panic. That's the textbook expectation. Price falls hard, sellers rush for the exits, dealers slash prices, inventory floods the market. That's not what happened. Coin shops didn't blink. Online dealers didn't rush to clear inventory. Premiums didn't collapse. In several cases, they quietly moved higher. That detail alone should stop you cold. Because in a real bear market, physical holders race each other to the door. Today, no one ran. Here's why that matters. Dealers don't trade for entertainment. They manage risk. If they dump physical silver at a discount during a paper flash crash and the price snaps back an hour later, they eat the loss. So when they refuse to lower prices, they're telling you something without saying it out loud. They do not believe the move is real. They see the paper market as a casino glitching under stress, not a signal of changing value. And if you were waiting to buy physical on the dip, you probably discovered the same thing in real time. The window, if it existed at all, was measured in minutes. Websites froze. Inventory went out of stock. The supposed $9 discount never made it to the street. That tells you the sell-off wasn't coming from owners of metal. It was coming from computers liquidating contracts. There was no line of people dumping bars. There was no flood of silver hitting the market. There was only forced selling in futures. And while retail traders were being shaken out, someone else was quietly celebrating. Think about the industrial buyer for a moment. If you're responsible for sourcing silver for solar panels, batteries, or electronics, you don't chase price spikes. You wait, you budget, you hedge. When silver flashed to 83, that was a problem. When it dropped to the mid-70s, that was a gift. Those buyers didn't panic. They clicked buy. That's why the rebound from the lows was so aggressive. The moment the forced selling exhausted itself, real demand stepped in. not speculative demand, structural demand, the kind that doesn't disappear tomorrow. And notice where the bounce happened, not randomly, right around $74 to $75. That level wasn't chosen by emotion. It was chosen by memory. Last week, 75 was resistance. When price broke above it, when that level flipped roles, old ceilings become new floors. Today, that floor was tested, and it held. That single fact changes the interpretation of the entire candle. Yes, the wick shows rejection at the highs, but the base shows acceptance at higher ground. We didn't fall back to where we came from. We landed above it. Now bring gold into the frame. While silver was thrashing, gold barely moved. No flash crash, no spike. Just calm stability near its highs. That's the anchor. When gold holds firm, it tells you the monetary foundation hasn't cracked. Silver is simply the high beta sibling. Louder, faster, more dramatic. Volatility isn't the warning sign, it's the admission price. If today's swing made you sick, the problem wasn't silver, it was exposure. Physical holders looked at the screen, shook their heads, and went back to their day. An ounce didn't change, only the paper did. So now we've established something critical. The drop was paper. The support was real. The buyers were real, and the sellers were forced. But there's another layer you haven't seen yet. Because right now, machines all over the world are staring at that same candle. And they're making decisions that will shape the next move. That's where this gets interesting. Here's where the story splits in two. To a human, that long wick looks like failure. A rally that tried to escape and got slapped back down. Emotion reads it as rejection, weakness, danger. To an algorithm, it reads very differently. Algorithms don't feel fear. They measure risk. And when silver trades a $9 range in a single day, their risk models light up. Volatility spikes. Position limits tighten. The machine doesn't think the market is broken. It thinks the market is unstable, so it does the only thing it knows how to do. It steps back. Over the next stretch, that means fewer aggressive buys, smaller position sizes, a market that drifts instead of sprints. This is how you get the chop. $2 up, 3 down, 1 up, 2 sideways. The kind of action that drains patience and destroys options without ever making a headline. This zone is not an accident. It's a wash cycle. Momentum traders hate it. Option buyers bleed in it. Anyone who needs instant validation gets bored or frustrated and leaves. That's the point. Volatility is a tax on leverage, and the bill just came due. But while short-term machines are backing off, another class of buyer is leaning forward. Pension funds don't care about daily candles. They care about monthly closes. They don't ask whether silver failed at 83. They ask whether silver is higher than it was last quarter. And compared to where we started the year, today's price isn't a disaster. It's a discount. Think about it from their perspective. The market just showed them 83. Then it offered 78. On a $1 billion allocation, that $5 difference is not noise. It's an opportunity. This is why crashes like this often strengthen the next leg higher. If silver had drifted sideways at the highs, institutions would hesitate. Too extended, too crowded. But after a violent flush, the runway clears, the tourists leave, the heavy capital feels safer landing. Now look at the volume profile of the move. The buying into the spike was enthusiastic but thin. The selling was sharp, emotional, and fast. Panic selling burns itself out quickly. Structural buying doesn't. It accumulates quietly and keeps going. That difference matters, and it shows up in producer behavior. If you're running a mine, today didn't inspire confidence in the exchange. It reminded you that the paper market can be distorted without warning. When that happens, producers don't rush to hedge future supply. They pause, they wait. They hold metal back. A silent seller strike. That removes supply at the exact moment banks need it most, because banks can only close short positions if someone sells to them. Today, they bought from liquidated speculators. But once those weak hands are gone, who's left? The strong hands. And strong hands don't sell because a screen flashes red. This is where the disconnect widens. Add geopolitics and year-end risk to the mix. Investors hate going into a holiday holding cash. Cash has counterparty risk. Metal doesn't. Ghost Week isn't just thin liquidity. It's quiet hedging. People parking capital somewhere solid while the world holds its breath. There's also a psychological shift happening faster than most expected. At $80, silver stops feeling like a bargain commodity. It starts behaving like a monetary asset again. Bigger price attracts bigger capital. Bigger capital changes the market itself. This is reflexivity in motion. So yes, the candle looks ugly. It was supposed to. It shook out the tourists, fed the machines enough volatility to step aside, and made the asset more attractive to long-term money. Which brings us to the part everyone actually cares about. What do you do now? Because the next 48 hours decide whether this was just a scare or the foundation for something much larger. If today rattled you, this is the checklist that separates survivors from casualties. If today made you feel physically ill, that's a signal. not a failing. Do this now. Audit your leverage. If a single intraday swing forced you to sell, you're too big in margin. Cut the paper exposure until you can sleep. Move risk into fully paid physical, paid-for miners or cash cushions. Volatility is a tax on borrowed money. Pay it down. Defend the $75 line. We bounced at roughly 74 to 75 for a reason. It validated last week's breakout. A close above 75 on the monthly candle changes the entire map. If you hold exposure, treat 75 as your psychological and tactical floor. If it gets tested again, consider it a buy zone. If it breaks, reassess quickly. Stop relying on stop losses during holiday vacuums. The market paints with a thicker brush when liquidity is thin. Stops are useful risk tools, but in ghost weeks they become hunting targets. If you use stops, make them tiny, position-sized stops outside the system, or better yet, trade small enough that you don't need to be stopped out. Set alerts, not obsession. For the next 48 hours, use price alerts and step away. The market will chop to punish attention. It wants you staring and sweating. Don't play that game. Decide size, set alerts, and return when meaningful candles print. Watch the physical flows. If inventories fall while price dips, it's bullish divergence. If inventories spike alongside price weakness, it's real selling. Study dealer premiums, vault receipts, mint stock reports. These are the truth serum for a noisy paper market. Think in time frames. Algorithms watch minutes. Pension funds watch months. Your actions should match your horizon. If you're long-term, the daily noise is an annoyance, not a decision point. If you're short-term, expect chop and reduce option exposure. Time decay will be the slow killer. Prepare a phased entry plan for January. If you want more exposure, don't try to catch single-minute dips. Ladder buys across the first weeks of January as institutional flows arrive. That spreads risk and lets you capture the next leg without gambling on a single flash. Mind the miners and suppliers. Producers are likely to pause hedging in a distorted market. That removes forward supply. If mining companies stop selling into paper volatility, the physical shortage intensifies. That's asymmetry you want on your side. Respect gold's anchor. As long as gold holds 4,500, the structural bid under silver remains intact. Silver is the volatile sibling, loud, impatient, and opportunistic. Gold is the adult. Use the ratio as a compass, not a tyrant. Recalibrate your expectations. We started the year at a much lower baseline. Being disappointed that it isn't higher yet is a wealth illusion. You're not behind because a daily candle looked ugly. You are ahead if you survive the shakeout. Final verdict on the shooting star. Context matters more than the wick. A shooting star at the end of an exhausted trend is a reliable top. A shooting star in a thin, low-volume holiday pivot is often a liquidity test. Combine the technical with the physical. We saw forced selling, physical resilience, structural buying, and a gold anchor. That mix reads as a cleansing, not a capitulation. Outlook. The next 48 hours will be choppy. Expect the $75, $80 range to dominate. If the market closes the month above 75, you validate the breakout and increase the odds of institutional inflows in January. If it breaks below, reassess quickly and respect the fresh technical damage. Last thought, surviving a rug pull is the core competency of anyone who wants to profit in a bull market. You earned the right to the next leg by simply not panic selling at the bottom. The market is a machine that rewards patience and punishes haste. We flipped the rug. The banks rinsed the leverage. The structural buyers showed up. The monthly close will tell us whether the classroom is ready for final exams. Enjoy the holiday, audit your positions, defend the floor, and get ready. The real money arrives in January.